Small cap stocks can bring extreme results. Owning a basket can give you value that can rise 10 or even 20-fold in some cases over the last year, but at the same time, it can go into bankruptcy with very little notice. Well, Paul Scott is a small cap investor who writes a blog on stockopedia.com. He holds shares in many small cap companies, and he joins us now with some of his stories to go over. Paul, first of all, Happy New Year to you.
And to you.
It's been a tremendous Q4, I know, for you.
Yes.
But before we talk about your stocks, we should just reiterate, shouldn't we, that these are not recommendations you'll be talking about today. These are just your thoughts, and indeed, in some cases, stocks that you own. Yeah,
I think I own all but one of the stocks that we're going to talk about. So I'm just throwing these over to people as ideas for them to look at, because I may have missed something, so it's very important people do their own research.
Okay, let's go back to October and talk about a couple of stocks I know that perhaps maybe one might like to brush under the carpet as something perhaps maybe might have been a bit of a mistake. Yes. Let's start off first with Crawshaw. So I'll revisit your commentary back in October. You do, I believe, still own this stock?
Yeah, I bought after the profit warning, which there's some very good research on Stockopedia actually done by my boss, Ed, where they did a huge survey of profit warnings covering about 250 of them or so, and the conclusion was buying after profit warnings is a really bad thing to do, statistically. Yeah, definitely. But I frequently break that rule myself, so yeah, I did buy some Crawshaw after the profit warning.
Well, let's look at the share price actually, because I think that says a lot, doesn't it? When we spoke in October, it was around about here, and of course it already had this big drop here, but since then it's seen another big decline.
Yeah, I mean, the key thing is really, to think about the fundamentals. One of the problems you've got with Crawshaw is you've got a couple of big holders, institutions, who are just dumping. They just want to get out. And so it's key to look for the holding and company RNSs to see who's selling. And if they're dumping repeatedly, I think it's best to hold fire. I jumped in too early here, but on fundamentals, I think it's very good value now, potentially. So it's still got cash in the bank, it's cash generative, and they're rolling out a slightly different type of store now, sort of out-of-town stores, which are performing very well. So I think there could yet be I think there is decent upside on this from this level.
Yeah, we should just say, I think this is a butchery chain, isn't it?
Yeah, it's a small chain of butchers in the north and in the Midlands. Yeah. The high street locations are coming under pressure from supermarket competition, but as I say, these factory outlet out-of-town sites are showing more promise. So I think this one's interesting at this low valuation, whilst accepting that the original big, aggressive rollout probably isn't going to happen now. But look at the share price, that reflects that.
Yeah, okay. Let's talk about another stock we've spoken about before, which now hasn't performed very well, is Fairport Group.
A Fair Point.
Fair Point Group, sorry.
No, this one's been a disaster. I think last time I only had a tiny holding in it, because as I mentioned in the last video, I wasn't comfortable with this one. I think I said at the time, it's either dirt cheap or there's something going badly wrong.
I think you said hideous. I think something hideous in the wings, I think.
Looking at the chart, hideous is absolutely the right description. It's been a car crash, this one. So, it just hasn't worked. Management told us everything was fine a few months ago, and the PE was extremely low. The dividend yield was 10 or 11%, which in itself is actually a red flag. I think when the dividend yield is that high, the market's telling you something's going badly wrong. And sure enough, out came this disastrous profit warning. The price has absolutely collapsed. The CEO's resigned. So yeah, hopeless.
You having a dabble at these levels or not? I mean,
I've kept what I've got, because I think the bank debt, which is the big issue, should be sorted by the large debtor book over a number of years. So I don't think it's going to go bust, but I'm not certain on that, so that's why I'm not adding to the position.
Yeah. Okay, talking about rolling out, an interesting theme, I think, here in some of the stocks today. We mentioned last time Revolution Bars.
Yes.
I mean, this is a stock that's done tremendous business.
Yeah, it's great. I really like this one. It's a good, solid company. I mentioned it last time, and I think it's risen, 20 or 30% since October, but so have lots of things. We're in a real bull market at the moment, so I think we've got to distinguish between stock-specific moves and general market moves. But this one's, it's great. It's got net cash, doesn't have any debt at all. Even now the PE is forward PE is only about 13, which is very good for a retail rollout. There's a 3% dividend yield. It's got cash in the bank. Now, I think there could well be a private equity bid for this. It was actually brought to the market by a private equity at £2 a share. I wouldn't be surprised to wake up one morning and find a £3 a share bid for this, or maybe more. and I've had 5 takeover bids in the last year in my portfolio. So it's a nice spin-off of my approach of looking for reasonably priced things. But the real interest is this Revolution de Cuba, which is a second brand that they've done that goes for a slightly older customer, typically in the mid-30s, 60% are female. The margins are amazing. The sales per square foot are amazing. It's a highly profitable cash-generative business, and they're beautiful bars. I've been to a couple of them. The fit-outs are £1 million a pop, so they really do them nicely. But they're paying low rents, and I think it's just a winning format, and I don't think the market has grasped that yet. So I see good upside on this.
Another rollout stock is Cake, or Patisserie Holdings, I think is the name of the company.
Yes, that's right. That's the Patisserie Valerie sort of tea and coffee and cake chain. This one's great, I think. It's never been cheap, but I bought in recently. I bought in about 280, 290, and they're a little bit more than that. Luke Johnson owns 38% of it, and things he touch usually do very, very well. Again, it's got net cash. It's a self-funding rollout, again, exactly the same as Revolution Bars, so it's generating enough cash flow to fund its own expansion in perpetuity. The margins are terrific, well into the teens in terms of the net margin. I think it's a lovely stock. I'm intending to holding that forever. It's a sort of buy and hold for 5 years plus, which you can do on spread bets. I mean, I've got spread bets open now that have been, one that's been running 11 years. So, it doesn't have to just be a short-term thing. And the other interesting thing is with these sorts of things, the dividends cover the funding cost of the spread bet. So, providing you're confident it's going to go up in the long run, you've basically got a free carry.
It's worth holding. Yeah, Fulham Shore, I think, also comes into this bracket of being a good sort of rollout stock.
It is. That's another rollout I really like that, again, I've only recently bought into. Fulham Shore.
What is it?
It's another restaurant chain, 2 restaurant chains rather. The core one, the one I'm interested in, is called Franco Manca. And they're only about 35 shops now. They are a pizza chain, but with a difference. They do some really nice differentiating factors, like they use own branded craft beers, which are only £3.50, and they're gorgeous and really, really great beers. The pizzas are terrific as well, sourdough pizzas, cooked in a wood-fired oven, just a brilliantly done format. And each unit they add on bolts on another lump of profit. They're all profitable, I think, the new stores. The payback period on them, same with Cake, is extremely rapid. So these rollouts are fantastic because you're just bolting on more and more and more profit with each site you open.
Just looking at the share price chart, it's a bit of a strange feel to it, isn't it? It's got lots of gaps in it, presumably not very liquid.
That's right. I mean, the market cap, I think, I can't remember off the top of my head, it's circa 100, 120 million, I think. But it's quite tightly held. Management own a lot, and management of all these 3 chains, actually, rather of Cake and Fulham Shore, management also are very, very experienced in rolling out. They've done it all before. This one doesn't trade that much. The spread's quite wide. It's not one to trade particularly, I don't suppose. Although sometimes the spread narrows to a quarter of a penny, which isn't too bad.
Right, okay, 20 pence a share.
It's not cheap. I mean, neither Cake nor Fulham Shore are cheap on current valuations, but it's all about, they've got winning formats. When you look 5 years forward, it'll be worth double, triple, quadruple.
Yeah. Talking about double, triple, quadruple, Gear for Music's done very well for you, hasn't it? Gear for Music, we spoke about this last time, and I think then you were fairly gung-ho about Gear for Music, and you've only got to look at the share price to look at, I mean, it's incredible
it's
performance.
Staggering, isn't it? Yeah, I mean, I bought this one originally at about £1, but only in very small quantity. And it suddenly dawned on me that this was really getting exciting around £1.80. So that's where I absolutely backed up the truck, and I haven't sold any of them. On fundamentals, I think this one's could potentially, in current market conditions, could go a lot higher. I mean, the forecasts were upgraded 20% last week, the earnings forecasts, and that comes on top of a 21% increase in forecasts in October. So the thing is, although the PE ratio and some of these stocks look very high, they grow into the valuation because the brokers are behind the curve. They can't keep up with the growth of the company. So it's like Fever Tree, that's another one. It looked terribly expensive, as did ASOS and Boohoo. But a year on, you find that the actual earnings they delivered can be, double what was being forecasted a year earlier. So suddenly your PE of 50 wasn't a PE of 50, it was actually a PE of 25.
Yeah. Okay, that's Gear for Music. Let's take a look at a couple of larger stocks that I know that you're interested in at the moment. Not so much the small cap. Enterprise Inns is probably one of the biggest stocks you've ever spoken about, I think.
It is. I mean, this obviously a major pub group. I think it's the biggest pub operator in the UK. Now, the reason I bought this one, I've had it for a little while actually, is because there was a bid for Punch Taverns. Now, Punch Taverns and Enterprise Inns are very, very similar in terms of their finances. Both have loads of freehold property, but loads of debt. But Enterprise Inns is double the size of Punch. Now, Punch has been bid for, and it's actually got 2 suitors covering it. So I still have most of my Punch shares. That's been another really successful one. Well, Enterprise Inns is basically a carbon copy, but double the size. So I think that could well attract bidders as well. And the freehold values of pubs are starting to rise now. So you've got that nice position where the freeholds are going up, but the debt's fixed and on fixed rates. So I think the market could suddenly get excited about that. Maybe, I don't know.
Yeah, okay, well, we'll hope on that one. Debenhams is another big one I want to talk about. Again, sort of off the top of what I would regard as your normal sort of interest area.
It is. I mean, though my background as an FD for a retail chain means that I disregard market cap limits for retailers. Debenhams, I think, is potentially interesting because it's a sort of stock that the market, as you can see from the chart, the market has kind of almost given up on. But what interests me in particular is that the new CEO is formerly from Amazon. So, and Debenhams already has quite a good internet e-commerce operation. It does about 400 million a year sales on the internet already, which is more than Boohoo, right. Interestingly enough. But of course, it's not growing as fast as that. So it's a bit of a punt. But what I think on Debenhams is there's a potential that maybe if the new CEO comes out with a really internet e-commerce focused new strategy, the market could suddenly re-rate this thing as a growth stock again. I don't know. It may or may not happen.
But you want it in your portfolio nonetheless?
Well, I think it's risk-reward, isn't it? I think you've got a lot of potential upside if this internet excitement does kick off. And on the risk side, it's actually a better performing business than a lot of people realise. Every year, everyone writes it off, and every year it's still profitable. It's actually not a bad business.
Vertu Motors, another one. This is a car dealership, isn't it?
It is. I mean, all the car dealer chains are cheap at the moment, but I particularly like Vertu. There's not a huge amount to choose between this one, Lookers, Pendragon, or Cambrian. I think they're all much of a muchness. But Vertu's quite liquid, so it's easy to trade. The forward PE is 6 or 7. Balance sheet's pretty good. The interesting thing is the market is worried about consumer demand. I think I mentioned car dealers last time. The worry, so people think demand's going to drop off a cliff, and demand for new cars is dropping a bit, but it doesn't actually matter that much because that's not where the profit comes from mainly. It comes from used car sales and after sales. So, and the exchange rate with the euro is now only actually gone back to where it was in 2013.
Right.
And car dealers were strongly profitable in 2013. So I think there's a chance that the market will suddenly say, actually, we don't think things are quite as bad after all for car dealers. So I think maybe 50% upside on that. At which point I'd probably bank my money and move on. Yeah,
okay. Speculative. Let's take a look at a choice that you're looking at the moment, which you say is a speculative choice.
I think it's fun to throw in one more speculative idea, but not, blue sky things. I like speculative stocks where the business model has actually been proven, even if it may not yet be much different from break even. And the one I've come across, and it may sound crazy, is Purplebricks, ticker PURP. This is a Neil Woodford favourite, obviously one of these new disruptive online estate agents, or hybrid one, which I think the business model is absolutely compelling if you go through the numbers. It makes a high profit margin, over 50% gross margin. It gets paid up front cash by the clients. It's got 29 million quid cash in the bank. On an underlying basis, it's trading around break even, and it claims to have over 60% of the market share of the new type of online disruptors, which means that it can outspend the others on marketing, which means it could end up in a winner-takes-all situation. And the bricks and mortar estate agents just can't compete with all their huge fixed costs. I think that one could absolutely turn that whole sector upside down. It may not, but I think it's in with a good stab at it. But the market cap reflects that. It's sort of 360 to 400 million, something in that range market cap, which is enormous for a business that's only around break even. But, we said that about Rightmove years ago. Yeah. It looked terrifically expensive, and look what it's done since. Yeah. Utterly dominated it. And this internet stuff is winner takes all, I think. So you can justifiably roll it forward 4 or 5 years and say that thing might be worth billions if it plays out as they hope it does.
Just want to go back to a point you mentioned mid-interview about the takeover thing. You spoke about Punch Taverns. Avesco was a stock we've mentioned before, which has been taken over. Lavender, I know we ought to talk about very briefly, because I think this is in the process of being taken over potentially.
It is.
Just explain what's going on here. Is it still worth getting in on this?
Probably not. I think the big gains happen now. Now, I did what I thought was right at the time and on the information I had, and I sold at about £1.90 to £1.95, which was when the initial bid talks were announced. Now, what happened subsequently is that a second bidder arrived, and we've had an amazing competitive sort of leapfrogging of the two bidders over and over and over. That's why it's gone up to that level. Now, I think so I think probably most of the gains have been had now. But there again, one of those two is going to definitely buy it. So you could say, okay, there may only be 10p downside, and there might be even further upside. So I don't know. It's up to each. Punch Taverns, I think, might end up in a similar situation because there's one definite bidder there, Heineken, but there's another bidder who's expressed interest, and the price of Punch Taverns is about 12p above the 180p cash bid. Now that's the market telling you there's a good chance of a higher competing offer.
Right. Okay. Well,
so I think with these bids, you've got to look at what the market's saying to you. You know, if the market price goes above the bid price of the initial bidder, there's a chance of a higher bid.
Okay, well look, we'll have to leave it there, but Paul, it's a pleasure. Thanks indeed for dropping in. That's Paul Scott, a regular blogger, for his small cap coverage on stockopedia.com.